All right, let's dive right into this explainer. If you've ever stared down a massive corporate structure, a parent company with a dozen different subsidiaries, the accounting can seem, well, completely overwhelming. How on earth do you make sense of it all? Today, we're going to cut through all that complexity and learn exactly how to present an entire corporate group as one single unified economic entity under IFRS 10. It's a pretty fascinating journey, so let's get into it. To keep things manageable, we've broken the standard down into 6 logical phases that we'll walk through using a continuous example. We're going to hit 1. The principle of control, 2. Doing the acquisition math, 3. The big combination, 4. Eliminating intra-group illusions, 5. Allocating post-acquisition profits, and finally, 6. Common consolidation pitfalls. Okay, kicking things off with phase 1, the principle of control. Now, before we even look at a single number or journal entry, we've got to understand the why. What actually triggers this whole process? Under IFRS 10, when a parent company acquires control over a subsidiary, the rules literally demand that we wipe away the corporate boundaries. You have to report the group's financial position, performance, assets, liabilities, and cash flows as one unified entity. In the eyes of the financial statements, you aren't 2 separate companies anymore. You're just one single organism. And here's the thing, it's not just about owning a bunch of shares. IFRS 10 requires 3 very specific conditions to be met before you're legally forced to consolidate. First up, you need power over the investee, meaning you have the actual rights to direct their relevant activities. Second, exposure to variable returns, so your returns go up or down based on how that subsidiary performs. And third, the ability to use your power to affect those returns. If you check all 3 of those boxes, boom, consolidation is mandatory. Moving right along to phase 2, doing the acquisition math. Let's bring in our running practical example to see how this actually builds. Let's say Parent Co. acquires 80% of Subsidiary Co. on January 1st, and they pay exactly $1 million in cash. The very first mathematical step here is measuring the subsidiary's identifiable net assets at fair value. And crucially, this has to be done on the exact date of acquisition. So we've got share capital at $700,000, retained earnings at $200,000, and a fair value adjustment of $100,000. Add those up, and in our example, that perfectly totals $1 million in net assets. But hold on, remember we only bought 80% of the company, right? That means there's a 20% non-controlling interest, or NCI, that belongs to other investors. 20% of that $1 million in net assets is $200,000, and this brilliantly sets up how we calculate our goodwill. We take our $1 million cash consideration, we add the $200,000 NCI, then we subtract the $1 million in net assets we just identified, and, well, we're left with a $200,000 premium paid for the acquisition. That right there is our goodwill. All right, on to phase 3, the big combination. So, we've done the initial math, we found our goodwill, and now we enter the combination phase, where we actually merge the financial statements. The golden rule here is honestly beautifully straightforward. You literally just add together all the parent's assets and liabilities with the subsidiaries line by line. Parent has cash, subsidiary has cash, add them up. They both have accounts payable, mash them together. This is the mechanical foundation of creating that single economic entity. But wait, if we just blindly add everything together, we're going to run into a massive double counting problem. See, the parent has an investment in subsidiary sitting on its balance sheet, while the subsidiary has its own equity sitting on its balance sheet. We've got to shatter these accounting mirrors with a huge foundational journal entry. So we debit the subsidiary's share capital, its pre-acquisition retained earnings, and the fair value adjustments. We also debit to recognize that newly calculated goodwill. Then, critically, we credit and completely eliminate the parent's investment account while crediting to establish the non-controlling interest. This effectively wipes the slate clean, so we aren't counting the exact same value twice. Which brings us to phase 4, eliminating intra-group illusions. Once those big double counts are gone, we have to clean up the internal mess. And honestly, this is usually the most confusing part of the whole process. Just ask yourself, if we are truly supposed to be a single economic entity, can the left hand sell something to the right hand and call it profit? No way, it absolutely cannot. Transactions within the group don't create real economic profit for the group as a whole. The illusion is that the parent sells goods to the subsidiary and records $100,000 in revenue, while the subsidiary records the cost of sales. If we leave that in, we are artificially inflating the size of our business. The reality is we must eliminate both. We've got a debit revenue for $100,000 and credit cost of sales for $100,000. We are literally erasing the transaction, as if it never even happened. And we've got to go even further. We have to completely purge any unrealized profits sitting on the balance sheet. Say that inventory from the intercompany sale is still sitting in the subsidiary's warehouse at year-end. Any profit marked up on it, like the $20,000 in our example, has to be completely reversed out. Same goes for transferred fixed assets. I mean, you can't just sell a building to your own subsidiary and magically trigger a $150,000 gain. I promise you, the tax authorities and IFRS 10 will not find that amusing. We also have to eliminate all intercompany receivables, payables, loans, interest, the whole shebang, just to reveal the true economic reality. Now for Phase 5, allocating post-acquisition profits. With all those illusions stripped away, let's fast forward to year-end and see how we allocate the actual profits the business generated. Let's say our subsidiary made $300,000 in profit after the acquisition date. Remember, only post-acquisition profits belong to the newly formed group. We have to carefully slice that profit up. The parent gets its 80% share, which is $240,000. The NCI gets its 20% share, or $60,000. That $60,000 then gets directly added to the closing NCI balance on our consolidated balance sheet, which tracks their growing stake in the subsidiary's success. And finally, Phase 6, common consolidation pitfalls. Look, the sheer volume of eliminations and journal entries here can easily trip you up. Before you finalize your statements, you absolutely need a strict checklist. A common mistake, accountants mistakenly including pre-acquisition profits as group profit. Don't do that. They are part of the initial net assets. Always, always ensure you're using the correct ownership percentages exactly at the acquisition date for your goodwill math. Don't forget to reverse those sneaky unrealized profits in your unsold inventory, and definitely don't forget to update your NCI with those post-acquisition profits we just talked about. Miss any of these and your entire consolidation is going to be out of whack. Ultimately, if you follow these steps, nail the acquisition math, and ruthlessly eliminate all that internal noise, you're fulfilling the entire purpose of IFRS 10. But it leaves us with one pretty provocative, real-world question. The next time you see a massive corporate conglomerate boasting record-breaking profits, what internal illusions had to be wiped away to give you that single number? Thanks for joining me on this explainer, and I hope this approach gives you some serious confidence in your next financial deep dive.